Stockholders' equity. Stockholders' equity is the owner's equity in a corporation. Sometimes you also see it as shareholders' investment or capital. Stockholders' equity is made up of two main sources, and these are very important as we go forward in the chapter. So the two things that make up stockholders' equity are, first of all, paid-in capital. That is the amount paid in by stockholders for their investment. Then the other part is retained earnings, and that is the income and the profits retained in the corporation instead of declaring them out as dividends. So those earnings have been retained and reinvested in the corporation. Paid-in capital is the capital contributed to the corporation by stockholders. So it can also sometimes be called contributed capital. And it represents the funds raised by the business from selling equity or selling the shares of stock, not from ongoing operations. The net income retained in the business is called retained earnings. So this is the corporation's cumulative earnings that have not been distributed to stockholders as dividends. These earnings are retained for use in the business and reinvested in the business. Looking at the retained earnings account, net income will increase retained earnings, whereas a net loss or dividends will decrease retained earnings. Because it's an equity account, retained earnings has a normal credit balance. So if there is a debit balance in the retained earnings account, that is called a deficit, and that is not good. That means that there have been accumulated net losses over time.